Hi, this is John Kosar of Asbury Research and Asbury Investment Management, and welcome to your Daily 5. Here are my top 5 charts for this week in just 10 minutes. The first chart we're going to look at is what we call the game board for our clients. We update the levels in the S&P 500 very frequently, and we use this as a means to determine risk and reward, where you want to buy the market, where you may want to take profits, where you may want to be looking for value. So we get the game board kind of laid out for everybody, and then we use several tactical tools to tell us what to do there. We'll take a look at those in just a moment. But for this chart, the big takeaway here is after we peaked on February 19th, crashed through the 200-day moving average, which is what most people look at as a major trend proxy. I think it's a very good one simply because everybody looks at it. We actually fell through our March 2009 uptrend line for a brief period at the end of March, but we held the 2016 high, August 2016 high, almost to the tick at 2193, and then it's been almost straight up since then. What we're watching this week is this level at 2822 to 2856. It's the August and October lows of last year, and it's also the 50-day moving average, which has come sliding down here pretty fast. That's 2830. So once you define a level, the next thing is, am I the only one looking at this, or does the market see it? It's pretty clear to me that the market sees this. We've really been bouncing around at this 2825 level for about 2 weeks now. If we take it out, the next level on the upside is 3010. That's the 200-day moving average again, and that's where everyone is going to be scratching their chin and wondering if this was just a bear market rally or if we're really starting to re-engage the previous major secular uptrend that started here back in March of 09. On the downside, I think the big levels on the downside here are, the big level is 2500, and that's that uptrend line. We really didn't spend enough time under here to indicate a solid break to me. So that's what we're watching on the downside. Let's go to the next one. Follow the leaders. What I like to do is keep a special close eye on the big cap stocks, especially the high beta ones, to see what they're doing. They often tend to be the tip of the spear in the market. This is Microsoft, a huge market cap, high beta stock. The linear correlation between Microsoft and the S&P 500 and both of the NASDAQs is very high. It's in the 0.8 to 0.9 area. So as goes Microsoft, typically so go those major indexes. Interesting what happened here. As the S&P 500 was falling apart, Microsoft came right into this support level that was a combination of the 200-day moving average here in orange and the July 2019 peak here in green here at 141.68. It got down there for about 2 weeks, maybe a bit less, but while it was negotiating in between this support and the 50-day moving average, it traced out an inverse head and shoulders pattern. And we've broken out of it, and we're still above there. If you look at the target there, it's 14% up above where the stock is trading right now at 198. That would indicate a new all-time high. So this in no way, shape, or form indicates that it has to go there, but it is indicating that a market leader is starting to perform better. It's back up above its major and minor trend proxies. So this is something we're watching really close. As long as this trend can hold up, ideally stay up above the 50-day here at 163.29, it bodes well for Microsoft, and per the correlations, it bodes well for the market. Market internals. 20 years ago, you could watch the S&P 500 and you can get a pretty realistic, lucid indication day to day of what the health of the market is. Algorithmic trading, in my view, has changed a whole lot of that. Now, you need to look under the hood. The way we do that is with one of our tactical models. This is called the Asbury 6, and these are 6 readily available indicators that we use. We actually back tested these quantitatively to see how well they work together. And the truth is they work quite well together. 6 different indicators. Only one of these is based on price. That's the rate of change in the S&P 500. The other 5 are what I would call under the hood indicators: high yield corporate bond spreads, volume, breadth, investor asset flows. So we use these 6 together to tell us when the market is internally healthy enough to be purchased on a tactical basis. Our tactical time period is at 21 days. 21-day moving average is our overlay for a lot of our tactical tools. This has been positive since April the 7th. As long as it stays that way, we are going to continue to have a tactical upward bias in how we're looking at markets and what we're expecting. Should these start to turn negative, they will start to populate. This is updated every day on our website after the close. Should this turn negative again, and 4 or more in one direction or one color would indicate a signal, that would tell us that the under the hood of the condition of the market is starting to weaken, and at that point we would go into a defensive mode. But right now it's positive. Here's another one that's interesting to me: generational extremes. What that means is at the end of March, a lot of strategic longer-term metrics we look at got down to extreme points of pessimism or weakness. This is just one of many. The percentage of NYSE composite stocks trading above the 200-day moving average. You could find this in the VIX. You could find this in percentage that the S&P 500 is underneath its 200-day moving average. There's a lot of them. But for this one here, you can see when the NYSE composite, when 20% or less were still above their 200-day, or 80% or more were under it, would be the other way to look at that. This is when everyone is saying, I've had enough of stocks, I don't want to be in the market. And this is just the time historically when you should be looking for value. This is not a timing tool. We use our Asbury 6 and other metrics for that. But this is telling you that you should be looking for value down around those lows at the end of March, because historically, although we're not going to be able to recreate COVID, we can look back across the spectrum of fear and pessimism and see that historically this has been a place to look for value. Finally, follow the money. A lot of the research we do here has to do with asset flows. I want to see where the money is going, because that's one of the only things I've ever come across in my career that consistently lead price. This is our own metric. It's a table that measures the percentage of assets in the percentage change of assets invested in these 10 sector spiders. And we break it down into 3 time periods: trading, which is 5 days; tactical, which is 21 days; strategic, which is 63 days. And what we're seeing right now is there is money coming out of financials and there's money coming out of industrials. If you go across in healthcare, there's money going in since 3/12 on both a tactical and strategic basis. And the newest of these trends, real estate, there is money going in since last week on both the trading and tactical time frames. So we are looking towards those sectors as places to potentially put some money to work, because we've got a little tailwind behind us. We've got some asset flows behind us, and we hope to ride those like a wave. So there's your Daily 5 from Asbury Research. Thanks for watching.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.